Welcome everyone to another edition of Our Financials Financial Forum. This week, our focus in the Wealth Wisdom Workshop will be on the rising healthcare costs, some of the obstacles that produces for retirees, and some things we can do to pay attention to getting those into your plan so that you can address those rising healthcare costs. But today we'll get started, of course, with our markets in motion. So Jeffrey will get us started with how the markets performed and how investors are feeling about that.
hmm Yeah, I think the biggest thing with the markets this last week was the interest rates. And because of the concerns around interest rates, the markets kind of pulled back a little bit. So we saw the S&P 500 drop about 1.5%, 1.43 to be exact. And then the Nasdaq Composite a little over 2%. The Dow Jones Industrial Average right at 0.85%, and then the international developed markets dropping 0.4%. Like I said, that just comes from concern around inflation pressures that may not be fully behind us, and then some rising oil prices, higher bond yields, all that kind of created some uncertainty around the Federal Reserve policy. Like again, the biggest thing is I think this week is interest rates. So when it comes to how the market is reacting.
Yeah, absolutely. And then, like I said, that kind of led over to the growth stocks. They faced kind of the
hmm
biggest pressures there, especially the technology and those growth oriented stocks. Those high interest rates, what they do is from a pure financial standpoint, and you look in the present when you start doing some, calculations that we do on our side, um, present value of future earnings makes those companies with those long-term growth expectations, they become particularly sensitive to these higher rising rates. Because if you think about it from an investor standpoint, if bond yields are going up and I can get free return without taking the risk, it's going to make the stock prices look a little less attractive. So that's why you saw that NASDAQ really get hit as well. Because of those interest rates. So yeah, let's flip over a little bit to those bond yields again and talk a little bit about those, Jeffrey, in terms of like where the 30-year treasury went, what's
hmm
happening in Europe and Japan, and again what those higher yields are kind of signaling to investors.
Yep. So, like you said, that 30-year U.S. Treasury yield reached its highest level that we've seen in 19 years, while sovereign yields in Europe and Japan also climbed to multi-year highs. So, a big thing that signals for us is that investors are demanding greater compensation for lending money through the concerns surrounding inflation, government debt insurance, economic uncertainty, and all that kind of stuff. So, um, as yields move higher, bond prices will fall, and that increased competition from fixed income can make stocks less um, attractive by comparison. So I'm kind of like you just touched on, talking about how the bond market relates to the market. So it flows over in that as well.
Yeah,
Um,
yeah,
mhm.
absolutely. And like I said, so that and that's kind of be one of the takeaways we'll talk about a little bit later is that these rising yields create some income opportunities. So we'll talk a little bit about that once we get into finance in focus, which will be next up. All right. So when we pivot over to our finance and focus section, and we're diving down again on this interest rate story. So kind of let's start with that, Jeffrey, and how this was an interest rate story and not really an earnings story about what happened this week.
Yeah, I mean, by you saying that it's an interest rate story, that just means that the volatility that we saw all week, it was driven through the movements in bond markets rather than weakness in corporate earnings. So the earnings didn't really play as big of a factor this week. It was kind of that movement in the bond markets, and it gives us a reminder that interest rates remain one of the most important drivers of portfolio performance. And that's across stocks, bonds, real estate, and private investments. They all kind of revolves around interest rates. Um, so that's kind of the biggest thing that we're seeing in this last week. And then from that, the bond markets are sending a very important signal. And I think it's more of a shift markets from asking when will the rates come down to how long are we going to be in this high rate environment, because it's starting to become taxes. So I'll let you kind of jump in from there.
No, yeah, you're exactly right. So as you just mentioned, that we got those multi-year highs in Treasury. Those yields suggesting investors increasingly believe that rates are going to remain elevated for a longer period of time. Um, And as you said, that distinction has a meaningful implications for borrowing, for investing, and for income planning decisions.
Yeah.
Um, Now, part of the other story though is the inflation piece and oil prices. So let's touch on what are some of the key risks that we're trying to watch right now.
Yeah. So crude oil prices moved higher during the week, and that kind of raised concerns that energy costs could put renewed upward pressure on inflation. Also serving as a reminder that inflation can be influenced by factors outside of traditional consumer spending trends. So investors are worrying that the higher gasoline prices, the transportation and production costs could feed through the economy and make inflation more difficult to control and stickier than anticipated. So, meaning that we could be stuck in this high inflation environment a little bit longer than expected. And a resurgence in inflation could delay any potential easing of monetary policy as we kind of talk about that rate reduction. So, that we're all kind of hoping for at some point. And this could influence Federal Reserve decisions and ultimately impact both equity and the bond market. So having an impact on both sides of the spectrum. So, um, yeah, I kind of let you jump into how I think one of the big things that we're seeing too is that this volatility also creates a lot of opportunities amid all the challenges we just kind of touched on. So,
Yeah, exactly. So, as our clients know, I think in August we've already traded 4 or 5 times, just tweaking the investments. As a matter of fact, I've got to put some trades in today to portfolios, but that volatility is creating some planning opportunities. Again, like I said, we're doing a lot of portfolio rebalancing. We're doing some tax loss harvesting, analyzing Roth conversion analysis, strategic gifting and charitable giving can come into play when you have all this volatility, and then how you deploy excess cash into these long-term investments. So a lot of successful investors often use this planning as often use volatility as a planning opportunity rather than a reason to alter their long-term strategy. So again, just keep in mind the diversification matters. At the end of the day, we got to stay well diversified, and that's going to be our best defense against these concentrated risk and the shifting market leadership.
yep, yep. Because diversification always going to help us stay focused on the long term goals rather than short term market movements, which is always kind of how we view planning in general. So, got to stay focused on the end goal.
Yep,
And that just
absolutely,
brings us to
absolutely.
the bottom line of where stocks have moved lower as rising bonding yields and higher oil prices reignited inflation concerns. The Treasury Department attempted to stabilize long-term rates through increased bond repurchases, and then markets remain focused on one central question, and that's how long will interest rates stay elevated. Um, and the current environment reinforces the importance of diversification, disciplined planning, and taking advantage of income and planning opportunities created by volatility, as Marcus just touched on. So I think that kind of wraps up finance and focus, and we'll be back with Wealth Wisdom Workshop as usual.
All right, perfect, perfect. So let's get started with the Wealth Wisdom Workshop today. Again, we're talking about the rising healthcare costs in America. It's really a retirement income crisis that we're facing with the healthcare costs and how quickly they rise. So, all right, so let's get started. Let's set some ground rules here. So we know we know healthcare costs will continue to increase. We know we'll likely need more healthcare as we age. What we don't know is when those expenses will occur, how large they'll become, or how long they may last. So we'll talk a little bit about why healthcare is different. So Jeffrey, what's different about healthcare
Mm-hmm.
cost than the other things that we see in terms of inflation and volatility and taxes? Why is healthcare so different and for retirees?
Yep, and I think it starts with healthcare isn't discretionary at all. You can't postpone it indefinitely. You can't shop your way out of needing it, and you can't choose not to participate in healthcare. It's something we all have to utilize and be a part of. So, and it becomes more likely and more expensive with age as we get older. Your healthcare quietly grows in the background year after year, often faster than general inflation. So that's what makes it a little bit different. And then we'll kind of dive in on some of these things more specifically. And we'll start with the healthcare inflation grows faster than traditional inflation, as I just start. And so that means your traditional inflation equals groceries, gas, housing, your everyday expenses. And your healthcare inflation has historically grown even faster than those things. And we're talking 5% to 7% per year. And that's more than double the long term rate of general inflation. So health care costs can double approximately every 10 to 14 years. And because retirement may last 25 or even 30 years, those increases compound dramatically over time. So that's why healthcare, the first reason why healthcare is such a big deal for us. Now let Marcus kind of dive into some more reasons.
Yeah. Second thing, as we're discussing here, as we mentioned at the top, is our healthcare needs increase as we age. So costs rise because of utilization. So we're starting to use it more, makes our costs go up. Most need more healthcare services as they grow older. Chronic conditions are more common. Prescription needs increase. Specialized care becomes more frequent. So our spending accelerates significantly later in retirement, and that's particularly beyond the age of 80. So the unfortunate reality is that many retirees experience their highest health care expenses precisely when financial flexibility is kind of declining.
Mm-hmm.
So now let's talk about that other thing, that long-term care shock that could kind of come in and derail a portfolio. So yeah, Jeffrey will wrap that piece up and talk about the gaps that our retirees don't really see, that we are able to kind of come in and plug that gap and close us out.
Mm-hmm. Yeah, so kind of going back to that long term care can create a financial shock. The largest healthcare risk is long term care. I mean, that's just very simply put. And then research and a significant percentage of retirees will require some form of long term care, home health care, assisted living, or skilled nursing care costs that can be substantial as we get towards the later years. A single long term care event can introduce hundreds of thousands of dollars of additional expenses into a retirement plan. And it's not just simply a healthcare issue. And 'cause I'm sure we've all a lot of us have been through some type of long term care needs, whether it's for parents or other family members. Um, it is a family issue. It's a legacy issue, and it is a retirement income issue because that's what's pulling their money at the end of the day. Um, so, like Marcus said before, there's gaps that people don't see where we like to come in and try to help people see those gaps. And the biggest gaps we often see is understanding future health care costs. Many people budget for retirement based on today's expenses. Healthcare costs 20 years from now won't look like what they look like today. Um, Most retirees don't intentionally ignore this risk. They just simply don't realize how much compounding can change the picture over time. Like I said before, that inflation number is a lot bigger than general inflation. And healthcare inflation is unlike many other risks because it doesn't require a market crash or economic crisis to happen. It just simply requires time and age. So it's allowing one of the most predictable retirement expenses to quietly gain control of more and more of your income assets. And that's kind of the biggest gap that we see. And I'll let Marcus kind of wrap this up for us.
Yep. So again, as you always kind of say, think about your retirement vision in terms of what you want that to look like financially, especially. And now let's think: does your plan have you really planned for your future healthcare costs with that same level of attention that you've given to your investment portfolio? Then ask yourself: will rising healthcare costs gradually take control of my retirement income, or have you built a strategy designed to stay ahead of that? So that's the goal again, is anticipating all these particular things that can derail that retirement that you envision. And those are the things you want to pay attention to. So great session today. Again, the market is moving all over the place, so pay attention to that. And we will see you all next time on Financial Forum. All right, take care, everyone.
Mm-hmm.